Every spring, millions of Americans overpay their taxes. Not by cheating the system, by being too polite to it. They leave money on the table that was legally theirs the whole time, and they never even know it happened. Here's the part that stings. Most of this isn't some loophole you need a $400 accountant to dig up. You don't have to itemize. You don't need a side business. These are sitting right there on the same form you already file every single year, and most people scroll straight past them. The IRS is not going to circle them for you. They will happily keep the difference if you never ask. There are 5 of them. By the end of this video, you'll know exactly what they are, who qualifies, and how to actually claim them. And the last one isn't even a deduction. It's better. Stay with me. First, the thing nobody bothers to explain to you. You've probably heard that deductions don't really matter anymore because almost everybody takes the standard deduction now. About 9 out of 10 people do. And technically that's true, for one kind of deduction. But there are 2 kinds. There's the kind you only get if you itemize. Mortgage interest, big medical bills, that whole pile. Most people can't beat the standard deduction, so they skip all of it. Fine. And then there's the other kind. The ones the tax world calls above the line. These come off your income before the standard deduction even walks into the room. You get them no matter what. Standard deduction, itemized, doesn't matter. You still qualify. Nobody talks about these because they're boring. They don't make headlines. And honestly, there's no industry built around telling you to do something that takes 10 minutes and costs you nothing. So they stay quiet. Let's make them loud. Number 1, the health savings account. If your health insurance is a high deductible plan, and a huge chunk of working Americans are on one without ever really thinking about it, you can open an HSA. In 2025, you can put in up to $4,300 on your own, or $8,550 for a family. Every dollar you put in comes straight off your taxable income. If you're in the 22% bracket and you max out a family HSA, that's almost $1,900 knocked off your tax bill in one move. And here's why people who actually know money quietly love this account. The money goes in tax-free. It grows tax-free. And when you spend it on anything medical, it comes out tax-free. There is no other account in the entire tax code that does all 3. Most people treat it like a checking account for Band-Aids. It's actually the best retirement account hiding in plain sight. Number 2, the traditional IRA. You can put up to $7,000 into a traditional IRA, $8,000 if you're 50 or older, and depending on your income and whether you've got a 401k at work, a lot of that comes right off your taxable income. Here's the part almost nobody uses. You don't have to do this by December 31st. You've got until tax day in April to make a contribution that still counts for the year before. So you can literally be sitting there doing your taxes, see that you owe money, move a few thousand into an IRA, and watch your tax bill shrink before you hit submit, and you didn't spend a dime. That money is still yours, sitting in your own retirement account. You just moved it out of the government's reach. Number 3, student loan interest. If you're paying off student loans, you can deduct up to $2,500 of the interest you paid this year, above the line. You do not have to itemize. A lot of people assume that because they take the standard deduction, this one doesn't apply to them. It does. It phases out once your income climbs high enough, so the big earners eventually lose it. But for most regular borrowers, that's a couple $100 back every year, just for paying a bill you were already paying anyway. Your loan servicer mails you the exact number on a form called a 1098-E. Half the people who get that form never bother to enter it. Number 4, the educator expense deduction. If you're a teacher, kindergarten through 12th grade, and you've bought supplies for your own classroom out of your own pocket, which, let's be honest, basically every teacher in America has, you can deduct up to $300 of it. Markers, books, tissues, hand sanitizer, the snacks you keep in your desk drawer for the kid who didn't get breakfast. Above the line again, you don't need to itemize. You just need the receipts. It's not a fortune, but it's $300 the system already owes you, and most teachers never claim it. Number 5 is the one I told you was better than a deduction, because it isn't a deduction at all. It's a credit, and there's a massive difference between the two. A deduction lowers the income you get taxed on. A credit comes straight off the tax you owe, dollar for dollar. $1,000 credit is 1,000 real dollars in your pocket. It's called the saver's credit, and it might be the single most overlooked thing in the whole tax code. If your income is under a certain line, and for a lot of younger workers, part-time workers, and single-income households, it absolutely is, the government will literally pay you back a chunk of whatever you put into a retirement account. Up to $1,000 if you're single, up to $2,000 if you're married. Let that sink in for a second. You save your own money for your own future, and the government hands you up to $2,000 just for doing it. And the people who need it the most are the exact people who've never heard of it. So let's add it up. The HSA, call it $1,800. The IRA, depending on your bracket, another $1,000 or more. Student loan interest, a couple hundred. Educator expenses, $300. The saver's credit, up to $2,000 straight off your bill. You're not going to qualify for all 5. Almost nobody does. But if even 2 or 3 of these fit your life, you're looking at well over $1,000 a year you've probably been handing over for no reason at all. Now, 3 things before you go. 1, don't mix up the deadlines. The IRA and the HSA both let you contribute for last year all the way up to April. Almost everything else slams shut on December 31st. Mark it down. 2, if you've been missing these and you're sitting there now realizing you have, you're not stuck. The IRS lets you go back and fix the last 3 years of returns with a form called a 1040-X. People pull real money out of the past doing this. 3 years of missed student loan interest or a missed saver's credit can add up to a serious check. 3, keep your paper. The real reason most people skip these isn't that they don't qualify. It's that when tax time finally rolls around, they can't find the form, can't find the receipt, and they just want the whole thing to be over. Start one folder, physical or on your phone, and the day any of these forms show up, drop it in. That one habit is worth more than every tip in this video combined. None of this is cheating. None of it is risky. It's just the difference between paying what you owe and paying what you owe plus a tip you never meant to leave. The form is the same one you already file. The money is already yours. You just have to know which lines to look at. Do it before you file this year. And if you've got an old return sitting in a drawer somewhere, go take a look. There might be a few $100s in there with your name on it.